Hey everyone, my name's Andy. My channel's Finding Value. If you like investing in very undervalued assets, the most undervalued that I can find in the world, this is the channel for you. I'm going to respond to some questions in the comment section so everybody can hear it. One of the questions is, would you allocate more into gold or commodity stocks now? How would you divide 100% between those two? And gold and silver is a one-to-one bet. You don't get any leverage to gold, obviously, because you're investing in gold. If you invest in a mining company, you could potentially get leverage, but sometimes it doesn't work because their input costs go up faster than the price of gold. And that's why I always talk about ratios, because oil outpaces gold. What happens at the end of bull markets is oil goes up at a faster pace than gold does, increasing the input costs of mining companies, and then the mining companies don't make as much money, and some of them, they don't even stay with the price of gold itself. So what I like to do is, if you like precious metals, I like to invest physically into the metals, because you don't have any of the mining company input cost risks. The other way that you can play it if you want to have leverage on it is royalty companies, and that's where I'd put money as well, is royalty companies and physical precious metals. And I skip out towards the beginning to middle. That's when I don't have any mining companies left. They're just royalty companies and physical precious metals. So where I do put my money is in the other commodities, because they are leveraged to gold. I'm putting it in natural gas, oil, uranium. Those are my favorite ones. And I do have a couple. I do have some silver mining companies, but gold mining, it's very little. Next, we've got a question down here, and this is the reason I started the channel, because I would hear people make statements on YouTube about this. It says the 10-year US government bond yield is spiking higher. Doesn't this alarm you with regards to the housing market? So house prices have nothing to do with interest rates. I'm going to say that again. House prices have nothing to do with interest rates. That is a wrong correlation. Now, if you looked at history and you were to plot this out, one would come to the conclusion that higher interest rates drive higher home prices. If you knew nothing and you just plotted it. Now, this is how it actually works. Home prices go higher. They move on up house price wise. Interest rates chase inflation. So in a housing boom, that's where inflation comes from. I'll step back. 97% of the money supply is created through commercial bank lending. 50% of that lending, of the 97%, comes from residential real estate. Residential real estate goes up in price, which signals that we need to build more homes. So it's a supply-demand imbalance which creates home prices to go up. That's the driver. Demographics is usually the driver of that real estate push higher. So ultimately, it's demographics that pushes real estate higher. When real estate goes higher, what happens is we get inflation. That inflation comes out into the system through commercial bank lending. That's 50% of that's 50% of 97% of the entire money supply. So when we get inflation, the people over in the bonds, they say, crap, we have real negative rates, which means that inflation rate is higher than the 10-year yield. So then they start selling bonds. This drives rates higher. So the root cause of real estate going higher is a supply-demand imbalance, which is usually due to demographics. This time, we have demographics of the millennials coming up, which is a larger demographic, and we have a housing market that's been screwed up from the previous housing boom with the mortgage debacle, which created all these foreclosures that came on the market and screwed up the new home builds. So we are underbuilt by 3.84 million homes. That means that we have a 1.5 yearly new home demand. We need to build 4 million above that yearly demand to work off the housing deficit. That's going to take time. That right there is where the inflation's coming from. This took me a while to figure out because it seems like everybody has this wrong. That money, that inflation that comes out, drives interest rates higher. Interest rates will chase it. It'll come behind and chase the inflation higher. Now, there's something extremely important I want to tell everybody, and this is extremely important. Real estate, with that inflation, is going to create different market conditions in the future. And what that means is real estate and the inflation from real estate is going to create higher interest rates. Now, higher interest rates reprices assets. Let me say that again. Interest rates reprices assets. When you have higher interest rates, people and inflation, so you have higher inflation and interest rates chase inflation, people are going to move money into inflation-protected investments. They're going to go into commodities, they're going to go into precious metals, they're going to go into all of those types of investments and real estate. They're going to sell bonds and they're going to sell your tech companies. Tech is in a huge bubble. And that's why I don't have any technology on this channel, is because it's in a big bubble. When this money rotates, it's going to rotate. It's going to be a massive rotation of money. And this is how money rotates throughout the economy here, or through sectors, I should say, through investment sectors. Money's going to rotate out of tech. It's going to rotate out of some of the regular stocks on the market. And it's going to rotate into emerging markets. It's going to rotate into commodity type companies. It's going to rotate into real estate. And we've already seen this happen. Barely. It's just starting. Now, I'm going to do some charting. I'm going to show you Apple, Amazon. I'm going to show you the charts of that. And they all look like they're putting in topping patterns. Tesla's going to, all these companies, they're going to get brought down. Because when interest rates go higher, they're going to be discounted to a higher interest rate. So it's coming. It's not overnight, and it takes time. We're seeing bottoming processes in commodities, and we're seeing topping patterns in some of these tech companies. And I'll show you what they look like. I'll do a charting of all this. So that is extremely important to understand of what I just went over in terms of rotation of money and how real estate sets the conditions for our investments. And I hardly hear anyone talk about this. Hopefully you like this clip. Give me a thumbs up. Subscribe to the channel if you like this content. And I'll do more videos to get you guys the necessary information to be successful investors. Thanks for listening. This is Finding Value.